Hi and welcome. Let's take a good look at groups, okay, in terms of group holdings and the percentage holdings. And also we'll look at how we'll look at the tax implications of these group holdings. Okay, so we take a very good look at the 51% group holdings, after which we'll then look at the next section, which deals with the 75% holdings. Okay, so here we're looking at 51% groups and then the payment of taxation. Okay, and then the payment of taxation. Now, the question is, when does a group exist for taxation purposes? So the key thing is when we have a parent and a subsidiary, okay? So where we have a parent, okay, a parent and a subsidiary relationship working, okay, operating. Now, the degree of control is very key. The degree of control is very key. So we're looking at how one controls the other. So it could exist between two companies, okay, or more, two or more companies. So the degree of control could exist. And again, this degree of control could either be directly, okay, or indirectly, So we're looking at two ends, one directly and the other one indirectly. So the degree of control is very key, and it could exist between or among two or more organizations. So in this very first slide, we're looking at three different relationships that exist. But in this very section, we only concentrate on 51% groups. The next one will be the second part of our presentation. Okay, to be the second part. But for now, our efforts will be on the very first one, the 51% groups and the tax implications or how they pay, or in terms of how they pay taxes. Okay, good. So let's drill down to only the 51% groups. Now, what is a 51% subsidiary? So usually we have a number of items that could determine or that could dictate the 51% subsidiary. So like I said, where you have more than 50% control or interest, okay? Either we're looking at control, so we're looking at either control or stake, okay? The main thing is control. The main thing is control, okay? Where sometimes you could have more stakes in the company, but you may not be able to control. So control is very key in order to establish who controls what, in order to establish a parent and then a subsidiary relationship. So when you have more than 50% of the shareholding, whether directly or indirectly, but again, where there is an element of control, then group comes in. Okay, group comes in. So we need to get a parent and we need to get a subsidiary. So companies again could be linked by a parent. So one parent as a standalone could also link, let's say, two different subsidiaries, let's say A Limited and B Limited, or it could even link up to another limited C. So the parent, if it is YX Limited, okay, could be able to connect these guys together. Could be able to connect these guys together or these guys together. So take note of that. Now, we are not dealing with individuals. We are not talking about individuals holding the shareholdings. No, we are not dealing with individuals. We are talking about firms, okay, entities. We are talking about entity or firm. So it's not about individuals, it's about entity or firm. So an individual that owns more than 50% of a company is not what we are talking about. We are dealing with companies which are controlled by other companies or stakeholdings, okay? Great. Now, let's take an example, okay? When are two companies related, okay? When are two companies related under the 51 rule? So we look at a scenario where one is a subsidiary and one is a parent, okay? So again, like I said, two or more companies could be connected together. Now, a company, as we find here, will become the parent. Is a parent, okay, or the holding company, okay? Now, a company owns more than 50% of B. and owns again more than 50% of C. So the groups we find could be A, B, and C. So A Limited is part of the group, B Limited is part of the group, and C Limited is part of the group. At the end of the day, the threshold we are looking at is that A controls more than 50% or owns more than 50% of the equity shares, okay? So B, C, and A form part of the 51 related groups, okay? Out of the 51 related groups, good. Now, one thing we can also look out for is where there could be indirect relationship. In the first instance, we are looking at direct relationships. So A Limited, for example, owns 90% of B and owns 80% of C, okay? Now, B Limited owns, okay, so B Limited owns 60% of D, and C Limited owns 55% of E. So for these, we can easily tell, yes, 90 and 80 are more than the 51. Okay, they are more than the 51% or more than 50%. So they form part of the group. So we can easily find A, B, and C directly, right? We can say there's a direct control or ownership between A, B, and C. A holding 90% of B and A holding 80% of C. But what about the relationship between A and E? What about A and E? So A and E is an indirect relationship. What about A and D? Again, this is also an indirect, and this is also an indirect. So to get it, the effective indirect rate of control is a 90%, which we find here, okay, against 60%. That will give us the effective rate, okay. Similarly, for A and E, it is the 80% against 55%, which gives us the effective rate of control, okay? So like, yes, from the initial scenario, A, B, and C are all related. But what about A and D? Okay, what about A and E? All right, so when we compute and we get our answer, we compare it against our 50% or 51% threshold, okay? So whatever answer we get, we compare it against our 51% threshold. All right, great. Now, in the next slide, we see the solutions of the calculations populated. So you realize that here, A owns 90 of B and 80% of C. So easy to compute them to find that A, B, and C are related. But the relationship between A and D, which was what, 90% times 60%, gave out what, 54%, which is greater than 50% of the shareholding, okay? So in this case, D is also part of the group. But when we take 80% against 55% in terms of the relationship between A and E, we are getting 44%, okay, which is less than the 51% holding, or 50%, or less than 50% holding, okay? So we cannot include the E in the group. Instead, we include A, B, D, and then C, okay? They form part of the group and not the E. All right, easy group accounting in terms of group accounting, okay? Now, when do we count companies relating to the 51% group? So if it is dormant, we exclude it, okay? If it is dormant, we exclude. But if it's active, we include it. Now, if it is active, what we need to look out for is that if it was only related part of the period, okay? So if it is only part of the period, include it, okay? If it's also existing at the end of the previous period, okay? Existing at the end of the previous period, include it. And whether it is UK company or not, we include it. So regardless of whether it is overseas or not. Once it meets these two criteria, we include it. Okay. Once it meets these two criteria, we include it, and the shareholding is over 50 or 51%, we include it. All right. An example. So A Limited owns 80% of B and owns 90% of G, right? Now, the effective, so these are direct. So, and it also owns 100% of E. Now, easily, we can see that E is a foreign company, but it doesn't matter. Once we own more than 51%, we need to include it. Okay, regardless of whether it is resident or not, we have to include it. So easily, we can see that A, E, and then B, right, are included. You may be tempted to include J, right, because the holding is 90%, but J, we have realized, is dormant. So if it is dormant, we don't include it. All right, but for A, E, and B, so B was 80%, E was 100%. Okay, so A, E, and B could easily be included in the group. What about the indirect between A and C? Okay, so A and C, 80% and 80%. What do we get? 64%, right? 80 times 80 gives us 64%, but it was acquired during the last cap. So still part of the existed during our previous year. We need to include it. Okay, we need to include it. So surely we would have to include C. But what about D Limited? So D Limited, the relationship between A and D would be 80% times another 80% times another 60%. And then we find our answer and compare it, whether it is greater than or equal to, okay, or less than or equal to 50 or 51%, okay, or 51%, and draw a conclusion. What about the relationship between A and F? So A owned 100% of E, and E owned 60% of F. So 100% of 60% is 60%. So easily, we could include F, okay? But what about this, the D? Of course, when you do a simple math, realize that this figure falls short, okay? Let's look at the next piece. So like I said, company A being the parent would have to include B, C, E, and F, all right? But for G, which is dormant, regardless of the fact that we still owned 90% of it, we don't include it. But for D, the computation gives us 38.4, which is less than 51 or 50% of the holdings. Okay, so we don't include it. Great. Now, what are the main implications of being part of 51% group? Okay, there's a greater chance that we'll have to pay our taxes in installments. Okay, now the due date for tax depends on whether the company is large or not. So the key thing is the due date for tax purposes depends on whether the company is large or not. Okay. Now, for a large company, we are looking at where the augmented profit is greater than 1.5 million pounds. Okay. Now, a total taxable profit plus the dividends should give us what we term the augmented profit. Okay. Now, these dividends we are receiving should come from outside the group. These dividends we are receiving should come from outside the group, not within the group. Okay. Now, the limit of 1.5 is reduced when the cap is less than 12 months. So possibly we have to prorate it, okay? And when the 51 group members are involved, okay? So take note of that, take note of this, all right? Now, the other main implication of the 51% group in terms of taxation is that, yes, we've established that there's a likelihood we can pay our taxes by installments to reduce our tax burden or spread the tax burden over a period of time, okay? Now, the augmented profits, okay, are usually employed to determine whether the company must pay tax by installments, but then we need to adjust it. Take note, we use it to determine, but we need to adjust it. How do we adjust it? By dividing it by a constant of n plus 1, where the n deals with the number of people within the group. Okay, so if we have 5 people, excluding the parents, okay, excluding the parents. So if we have A, and within the A, it has it has B, C, D, and E. Okay, we don't include this, all right? So it is this 4 plus 1, okay, which gives us 5, okay? So the N deals with the number of those related in the group, okay? I don't know why there's a 1, but more or less looks like the 1 could apply to the parents. I'm not too sure about that. All right, so that's the rule, N plus 1, okay. Now, the question is, what should be the limit? What limit should be divided as in example 1, okay? So in example 1, we had A limited, having these 4 related guys, okay? So N is 4. Therefore, how should we divide this? It becomes plus what? 4 divided by 4 plus 1. So we get 1.5, all right, divided by 5, okay. That's it. So divided by 5. So we divide it by 5. So 1.5 divided by 5 gives us augmented profits of 300,000, okay, of 300,000. Now, if the A's augmented profits is greater than 300,000, what do we do? Do we classify it as large? Do we have to pay installment taxes by installment, okay? Or what do we do? I mean, that's a question. But if it is less than 300,000, what do we do if its augmented profit is less than 300,000? Remember, augmented profits is our total taxable profit plus the dividends, which come from outside the group, okay? So take note of that. All right. Okay, so now there are 2 relaxations, okay? 2 relaxations in terms of the installment payment rule, 2 relaxations. 1, we need not pay, or the group need not pay by installments where the tax liability is less than 10,000. Even if the company is large, okay? Even if the company is large, once the tax liability is less than 10,000, we need not pay, we need to pay in full, okay? Where also the company is large this year, but not large last year, and the augmented profits do not exceed 10 million for the current cap, we do not pay by installments. Take note of that also. As usual, we'll have 10 million under the scenario where it was large this year, not large last year, and divide by N plus 1. So we're going to pick it one after the other. We'll treat this as one scenario, and we'll come back to treat this as a second scenario using some case studies or an example. All right, let's continue. So under relaxation 1, so the company is large, okay, but has tax liability of less than 10,000. We could reduce it if it's short periods or prorate it, okay? Now, it may affect the company in a very large group. The 1.5 million limit may be so far divided that a company with relatively small profits and hence a tax of 10,000 is deemed large, okay? We understand this once we start looking at the figures, okay? Not worry too much. Now, the tax authorities, they are always happy to accept payment in one installment and not in bits or in pieces, not in piecemeal, all right? So let's take one example. Now, Beta Limited has a cap of 12 months to 31st March. Now, it is one of 70 subsidiaries in the group, all right? So our N is 70. Our N is 70. Total taxable profit is 30,000. No dividends were received, okay? So our augmented profit still remains 30,000. If there were dividends, we would have added it. Is Beta large? What is its tax liability? Should it pay by installments? Okay, let's assume tax rate of 19%, okay? So this is the analysis we'll have to dig into. So take note of the figures, and then we'll be able to easily draw some conclusions. Now, cap is 12 months. Remember the rules under the relaxation 1, okay? Therefore, the limit becomes 1.5. And it is part of a 51% group related companies. Therefore, our N plus 1, N is the 70, plus 1 is 71. So we divide our 1.5 million by 71, and we get 21,127. Now compare our taxable profit, right, of 30,000. Remember, there were no dividends. So we compare this to the 21 and realize that our profits, which we have, okay, the augmented profits is actually greater than this threshold, okay, the revised threshold. Therefore, we say yes, it is large. If it was the other way around, we'll say it is not large, okay? So it is large. What about its tax liability, okay? So it's simply the rate against this percentage. Should it pay by installments? Okay, now let's check and see. Now, the tax liability, like I said, is augmented profits times 19%. We get 5,700. Should it pay by installments? So again, we compare it to the threshold, okay? The company is large, we've assumed, we've calculated, not assumed, sorry. We've determined that it is large. But what about its tax liability, 5,700? So we need to compare this 5,700 to the what? 10,000 limit to determine whether we should pay in installments, okay? Now, you realize that these are TTP, which was still the same as our augmented profits. Tax liability was 19% of that, which gave us this, okay? Should it pay by installment? When we compare it to the threshold, realize that it is less than 10,000, therefore no need for installment. We need to pay it as a one-off, all right? We don't have to pay by installment. Let's take relaxation 2, okay? In the scenario where the company is large this year, but not large last year, its augmented profit do not exceed 10 million for the current cap of 12 months. So again, 10 million would have to be divided by N plus 1, same as the 1.5, okay? And the question is that, or the point we should know is that this allows the company 1 year in which to move to the installment rules when profits and taxes grow, okay? So I wasn't large as a company. I was not large last year. Today I'm large. So it gives me 1 year to move to the installment rules, okay, to installment rules once profits and taxes grow. Let's take an example. So Cons Limited, its current its cap is 12 months to 31st March 2021. 5 wholly owned subsidiaries. So N is 5, right? TTP is 500,000, and then we are told that with dividends received, dividends which were received were outside the group of 20,000. So our augmented profits typically will become 500,000 plus this outside dividends, okay, which gives us 520,000. All right. So we keep that, at least keep the N of 5 and the augmented of 520. It was not large last year, it's large this year, okay. So let's proceed. What is the threshold? So let's find a threshold. What are the augmented profits? We found it there. We show the calculation, very easy. We'll revisit it. Is it large? We use the benchmarks to determine whether it is large. Should it pay by installments? Should it pay by installments? Okay. Now, what is the threshold for the year ended? Cap is 12 months, so we still use the 1.5, okay? So the number of related companies within the 51% groupings or group holdings is 6. It was N plus 1, okay? N was 5, so N plus 1 gave us 5 plus 1, which gave us 6, okay? So our revised threshold is to divide this by the 6, the 1.5 by the 6, giving us 250,000. Okay, if we should hold this constant, okay, what is the threshold? We are looking at what is the threshold for the year ended. If we want to use this, what conclusion do we draw? So the revised threshold becomes 250,000, okay. Now, TTP, like I said, was 500,000. We received dividends of 20,000 outside of the group. So augmented profit is just a sum of the two. So 520. Pretty easy, right, to understand. So we are looking at the question, what are the augmented profits for the year for the year to 31st March. So quite easy to find it over here. Okay. Assuming these dividends were within or from the group, we would have excluded it. Okay, we would have excluded it. All right. So revised threshold from what we calculated was 250. Augmented profit was 520. Now compare these augmented profits against the threshold of 250. Realize that our augmented profit is larger than the revised threshold. Therefore, our company is large. Okay. Therefore, the company is large. What about being paid? What about the payment in installments? What are the payments of installments? That's the next thing to look at. Now, the relaxation 2 states that if the company is large this year, but not large last year, and its augmented profit do not exceed 10 million for the current cap, then it need not pay by installments. Okay. However, we need to do some drilling down to see. So the 10 million will have to be divided by n+1. Okay. Now, this is the first year that the company was large. Okay. So augmented profits, again, let's repeat it, 520. So let's use the relaxation 2 limit, which is the 10 million divided by the n+1, 6, give us 1.67. Now, compare the 520 to the 1.6. So we realize our 520 augmented is less than this, okay? So should it pay in installments? No. Okay, it's less, so no. You cannot, we don't pay in installments. Good. When would the installments be due? Okay, so this is typically the timelines or the dates. So normally we consider the year ended 31st March 2021. First, find the first date of the year, and then the first installment is 6 months, 14 days from the start. Okay, the remaining installments, when do we pay them? Which dates? Okay. So when would the installment be due? If yes, okay, if installment is due, if we are to pay by installments. So year ended 31st March 31st March 2021, get the first day of the week and it should be 1st April 2020, right? The first installment will be 6 months, 14 days from the start, which is when you do the calculation, which will be 14th October 2020, okay? Now, the remaining installment, when do we pay it? If yes, we have to pay the installments, okay? So the remaining installment will have to be spread, and then it will be 14th January 2021. Check what is the duration between this and this. And then 14th April 2021. Check what's the duration between this and this. And then 14th July 2021. What is the duration between this? Check. Okay. Find the period lapse between them. Okay. Now, when would the installment be due if the cap is 6 months? Okay. 6 months up to 31st December 2020. So if it is up to 31st March 2020, our tax liability, assume there's a tax liability or the TTP is 130 with a 19%, we get 24,700, okay? If we are paying in installments, what do we do? Get the final installment 3 months, 14 days after the year end. That's the rule. Now get a first installment 6 months and 14 days after the start and check if there is any other quarterly payments falling in between, okay? Any quarterly payments falling in between. So in that case, our first one installment will have to fall on 14th April 2021. Okay, get a final installment 3 months, 14 days after the year end. So final installment would have to be paid 3 months, 14 days after the year end, after this year end, which falls on this, okay? So that is part payment or half of it. But if are there other quarterly payments in between? Yes, check and see. So it means 1st January 2020, 14th January 2021 will be the immediate payments or period for paying the remaining balance, okay? So no others will fit in, okay? And that should be it. Now, further implications of being part of the 51 groups, okay? Like we said, dividend received from within the groups are disregarded. We are continuing the example 3, okay? So all the dividends received by A Limited from B, C, E, and F should not be added to the TTP if A Limited is large for payment purposes, okay? That's it.